In this video, I will demystify the top 5 words that you will hear in every real estate investing conversation. Welcome back to my Wealth Builders Realty, where we cover all things related to real estate investing in the chart-topping Boise metro area of Idaho. I'm your host, Sylvia. Today, we are learning new words and a little math. If you're looking to start investing, then follow along because these terms will set the foundation for your real estate investment journey, and they will help you navigate the complexities of the real estate market more effectively. First up, appreciation, my absolute favorite word in real estate. Simply put, appreciation refers to the increase in value of a property over time. So here's the deal. Just like stocks, real estate can go up and down due to market conditions. For example, the financial crisis of 2008 caused real estate values to plummet. Then, in 2020, a global pandemic set off the biggest appreciation run that we've seen in a long time. And today, higher interest rates caused real estate values to dip again. But here's the important thing. Real estate is not a short-term game. Actually, holding on to real estate over the long term is where the real money is made. Black Knight reported a national appreciation rate of 3.8% per year. So, 20 years times 4%, 80% over those last 20 years. Not too shabby, huh? But if there's one thing I want you guys to remember is that real estate is super localized. Location, location, location is what they say, right? So let's take a look at what happened here in Idaho, and more specifically in the Treasure Valley area of Idaho.
So I'd be remiss if I did not tell you what has been going on in the Treasure Valley of Idaho, where I live. I have a couple charts here that I want to share with you. One is for Ada County, where the city of Boise is, and the other is for Canyon County, which is where Nampa is located. So back to Ada County. Just a quick note, these statistics were put together for us by a professor at Boise State University. She compiles these numbers using the local multiple listing service. This isn't an in-depth look at today's real estate market in the Treasure Valley. I will put together videos on that topic later, but what I want to point out right now is how the market has performed over the last 16 years. So as you can see, this goes from 2006 down here all the way to 2022. If you remember, just a few minutes ago, I was talking about just one of those market conditions that affected real estate value. So here, 2007, 2008, right? You can see that in 2007, that's really in Ada County where the property values were the highest. And, 2008, they dropped to 240,000. That was in Ada County, the median home, and basically dropped all the way down into 2011. So over those 5 years, prices in effect dropped 36%. Fortunately, in 2013, the property value started to rebound. Actually, 2012, you can see that it started going up. So this trailing 10-year trailing average you can see here is 13%. So over these last 10 years, 13%. But yet over the last 5 years, starting in 2018, it went up to 17%. So let's take a look at Canyon County. Like I mentioned, Canyon County is where Nampa is. We can see that the 2008 crash actually had a much bigger effect. Property values went down 50%. So if we look at the rebound, 10-year trailing was 17% right here, and the 5-year trailing starting in 2018 was up 20%. Now, that is pretty impressive if you ask me.
If you want to learn why I recommend Nampa as a great place to invest, check out this video. Now, a bit of caution. I saw many a newbie investor counting on appreciation when they purchased a property to make their money on the short term. So here in the Treasure Valley, we were seeing tremendous gains on a monthly basis in appreciation. So it seemed pretty smart that if you purchased a property, held on to it for a year, while it appreciated, you'd be able to sell it at a profit. But here's another popular saying in real estate: you cannot time the market. So what happened, these interest rates went up rather quickly, and many investors were caught trying to sell these properties because they didn't take into account other critical factors when it comes to buying real estate. More on that later. For now, let's move on to our next word, equity. You have most likely heard the word equity when buying your own home, or maybe when you refinanced your home. The equity in your home is the difference between the value of your home and what you still owe on it. So equity belongs to you, even though there are some steps that are required for you to get access to that equity. So here's a quick way to determine the equity in your property. Say that you bought a rental and you paid $300,000 for it, and you borrowed $240,000 on that property right here. So the equity, $300,000 minus $240,000 gives you $60,000. Now, if you were to turn around and sell that property right away, you would stand to make $60,000 on the sale of that property. Now, first, very rarely do people turn around and buy something and then sell it right away. Now, there are other ways to get equity. So, for example, let's say that this property, instead of paying $300,000 for it, you pay $280,000, but it's still worth $300,000, and you're still borrowing $240,000. Well, now that equity, you just got $20,000 in equity just by buying that property under value. Now, you can also do it the other way. Let's say you buy it for $300,000 and you make some renovations to it. Renovate the kitchen, maybe the bathrooms, you put new floors, maybe a new roof. Well, now let's just say it's worth $320,000. Well, now you've increased that equity again by that $20,000. Now, those are rather short term, you would probably agree, but equity for most is something that happens over the long term. First, you're going to be making monthly payments, and part of that monthly payment will include a portion that will be attacking this $240,000. So that will go down over time. Second, like we just mentioned, as the years go by, your property goes up in value, thus widening the gap between these two items, giving you a higher equity. Using the national appreciation averages that we just spoke about earlier, 3.8%. So let's see what happens. You buy that house for $300,000, 3.8% times 5 years. In those 5 years, you have gone up 19% for that property. Now, 19%, we're going to take that 19% and apply it to our 300. 300 times 0.19 is going to give you $57,000. We're going to add that $300,000 to the $57,000, which gives you a value of $357,000. And we're going to remove what we owed. Remember, value minus what debt is owed is what gives you your equity. So just to keep things simple, we're going to keep the $240,000. And the reason being is, if you've ever had a mortgage, most of those payments, those monthly payments that you make to the mortgage company in the very beginning, very little of that amount actually goes to your principal amount, which is what you borrowed. Most of it is interest, unfortunately. So to keep it simple, $240,000. So we subtract that 240 from the 357, giving us $117,000 in equity. Doubling my equity in a property just by making the payment, just by owning it for 5 years. I think that's pretty good. So this appreciation is what allows us to grow this equity. And every time we grow the equity, we can refinance that property and pull that out to use it on another property if we needed to. Which leads me to my next term, loan to value ratio. So the loan to value ratio means the ratio between what the property is worth or appraises at and what you want to borrow. So I will write down this formula for you. LTV, loan to value ratio, is MA divided by APV, where the MA is the amount that you are asking to borrow and the APV is the appraised value or what the property is worth. So in our last example, we had a $240,000 loan is what we wanted to borrow and a $300,000 property, which gave us a 0.8 ratio, or I guess you would say 80% loan to value ratio. Loan to value ratio is important for two reasons. First, the lower the LTV, the lower the interest rate the bank will charge you. And so really it comes down to how much skin in the game do you have. So of course the bank is thinking that if you are putting in 20%, you're much less likely to default than if you only have 5%. While a lender might go up to 95% loan to value on a property that you intend to occupy, very rarely are they going to offer you that same amount on something that you're going to let somebody else live in. The second reason that LTV is important is because LTV ratios and equity go hand in hand, right? If you have a lower LTV ratio, you have more equity. So if you wanted to get access to that equity, instead of selling the house, you would pull that equity out through a refinance. Now, lenders do have a limit on how much they will allow you to pull out. For your personal residence, you can use a HELOC, a home equity line of credit, and I've seen most banks do up to 95% LTV on your personal residence. For investments, that's typically about 75 to 80%. Although with the tightening of the market as of late, I've heard of some lenders reducing that all the way down to 50%. But before you go out and get a HELOC on your personal residence, just know that there are some inherent risks in putting your own personal house on the line. This leads me to my next term, cash flow. And unlike equity and loan to value ratios, cash flow is specifically for investment property. Cash flow is what every investor dreams of and the reason for many math calculations. Cash flow is basically the amount of income generated from a property after all expenses have been taken out. So basically your profit at the end of the month. As far as expenses go, what is included? Mortgage payments, not only those that you take out on the property, but if you borrow a HELOC on your own personal property, you want to include that as well. You want to include all property taxes, your insurance, also any operating and maintenance expenses should all be calculated. Cash flow is very important to you as an investor. I will not go into detail on how to calculate cash flow in this video. To learn all things cash flow, because cash flow does deserve its own video, check out this video where I go into all things related to cash flow. Our next word is depreciation. And depreciation is also specific to investment properties. So let's see what Merriam-Webster's dictionary defines accounting depreciation as it is sometimes referred to. Accounting depreciation means to deduct from taxable income a portion of the original cost of a business asset over several years as the value of the asset decreases. Leave it to tax people to flip the meaning of something that is negative to a positive connotation. No one ever wants to depreciate a property in real life. I just finished telling you about the importance of equity and how it relates to the value of a property. Less value equals less equity. But in the tax world, this definition is a crucial perk. When you hear in the news that a certain somebody paid almost zero income tax, you look at your own income tax return and say, how do they do that? Well, through depreciation. Real estate is one of the most tax-advantaged investment vehicles out there. The IRS tax code has been written carefully to incentivize certain behavior. In the example of real estate, the IRS tax code wants to incentivize individuals and companies to buy properties for someone else to live in. And this could be a risk, right? There is no guarantee that at the time that you sell this property, it will be on an upward appreciation. Now, there's also no guarantee that you will get a good tenant that will continue to make payments on that property so that you can continue to pay the property off. The government, in the form of depreciation, gives you an incentive to do this anyway. Most properties are depreciated over a set schedule of 27.5 years. So theoretically, you could take a deduction for 27.5 years while you own that property. Imagine what could be done with 5 properties or 10. That's when things would really get fun. Hey guys, thanks for tuning in. I hope you got some value out of this video. Now, by no means does this video cover every single word that you will encounter in your journey in real estate investing. I really just wanted to give you the ones that would be the most important for you to know when it comes to investing. When my husband and I started on this journey, we did not know any of these words. Still, despite our ignorance, real estate investing really afforded our family quite a bit of opportunity. So am I happy that I learned these words about investing? Yes, I am.